Good morning, traders. Chris Buss here with Traders Profit Compass with your morning look at markets for Wednesday, December 15th, the day we've all been waiting for. Jay Powell on deck. Yeah, so ready to go. Don't forget, if you're new, please run your player at 1.25 to even 1.5x to plow through the material quickly. And you can always pause if there's something there you want to think about, look about, make a note about, etc. So, futures are pretty much dormant, as you'd expect, ahead of the Fed policy announcement at 2 o'clock. Remember, 2 p.m. is the written statement, 2:30 is Jay Powell. The conventional wisdom is the first move is fake, right? The knee-jerk move, whether that's down or up. The question to interpretation of that rule, or rule of thumb, if you will, is how long is the first move, right? Is that the rest of today? Is that into tomorrow? Is that the first 30 minutes? That's always a game time decision. And what your time frame is on your trades. If you're like a super active trader and you see some two giant green bars and then they start fading it, then you can decide if you want to jump on that. Same by the same token, if you see some massive red bar right when that announcement prints and then you see them buying it up, if you hit a level or something like that, you can do well if you've got an objective entry. That's not really my thing, but that's probably because I'm not that good at it. So if you're good at that kind of a trade, by all means, you probably will see some volatility after the print comes out. Also, so if you're on the daily time frame, you can just as easily just let the rest of today play out, because I think it's going to probably take today and into tomorrow and maybe even Friday. Remember, we've got the quad witching on Friday, so that's a big options expiration. So long story short, I don't think there's some kind of massive urgency that you just all of a sudden gotta dive in full bore. Let things settle out. Have your levels marked on stocks that you watch closely for active trading. Have your alarms set on other stocks that you're interested in buying at certain levels. And if you get a rogue spike lower or whatever, then you can be ready and not be kind of like deer in the headlights, not knowing what to do when things start moving. Over on the macro front today, ahead of Powell, we've got retail sales, Empire State Manufacturing Index. We've got a housing number, and then of course Jay Powell at 2. Tonight after the bell, we've got Lennar and Trip.com among a few other minor players after the bell. And then tomorrow before the bell, we've got Adobe and Accenture Consulting. And then after the bell tomorrow afternoon, we've got FedEx, which will be, I imagine, pretty closely watched. So let's plow through these charts. There were some really, really nice trading ops yesterday that I want to point out in the charts. Hopefully the levels helped you yesterday if you're an active trader. So let's start out with the 10-year. We've had all these gyrations, mostly COVID-driven, I'd have to say. We've settled in here between 1.5 and 1.4% on the 10-year. I think those are just the basic areas to look for today and in the days ahead. A drop below 1.4, calls into question future growth, and get a breakout above 1.5 then we probably would be racing up towards the top of this range, which is like let's just call it 1.65. So that would be, maybe as a result of a hawkish statement by the Fed. Remember, I think the expectations for today is a doubling of the taper, going from 15 to 30, wrapping up bond buying by March, and then a projection on rate hikes for 2022. And I think the consensus is 2 rate hikes. So you can use that as a benchmark when you're getting that statement read. And if you're watching financial media or whatever, they'll review what those expectations are. And then if the statement comes out more hawkish than previously expected. And I think a lot of that is going to be in Jay Powell's tone at the presser. Usually the written statement, unless it's just bold and they want to make it just like crystal clear, that his comments can add a lot of color and texture to the written statement. So the written statement may be worded a certain way, but then if he's pressed or if he wants to volunteer extra information about their posture, then he would do that. So, I mean, as I said in the notes today, we're entering a period of transition on the liquidity. So we've been in massive injection mode since the COVID bottom, and now we gotta get off the we're going to get off the liquidity train. And whenever there's a transition like that, it's usually messy. It doesn't necessarily mean that we've got to resolve downward, but I think the chances of a downward move are a lot higher than they were just a couple of months ago. And I think with Powell's reappointment now and inflation's persistence and elevated 40-year levels in inflation, I think, if you look at Powell's mandate, okay, I'm reappointing you. We got to kill inflation because there's pitchforks in the streets. We've got to keep the economy from cratering. You can't cause a recession by whatever you're doing to fix inflation. And 3, make sure the stock market doesn't crash. Now, if it boils down to having 2 out of 3, I think the stock market's the odd man out, right? I think the Fed put is a lot lower than it was just a couple of months ago. I don't think they're going to rush in with an 8% drawdown. I think they'll go back into the mode. Well, we got to get inflation tamed down, and we're more worried about the economy right now than the stock market. So it is what it is. So I think in that scenario, I think Powell has his marching orders, and just like I said, if push comes to shove, I think the market's the odd man out. So we got to be aware of that. And I don't think it's going to be a unidirectional trade like it has been over the last couple years. So enough rambling. TLT in the middle of the box here, 150. That's a tough trade coming out of Powell. That's above my pay grade. You're going to get probably a big bar in here today, a wide range bar. Go down and then come back up, that kind of a thing. So I'm interested in what the rates are, but I'm not interested in trading TLT right at the moment. We've been watching the VIX carefully. We were higher yesterday on all the turbulence, closing around 22. I think my scenario is definitely in play. And if you're new to the channel, my scenario is we came back to fill this lower gap, Now we've made a move up here, certainly within striking distance, to fill this upper gap. And I would say if we got some kind of a massive spike, after Powell, and we come up here in the 27, 28, 29 range and fill this gap, I think you got to be looking to buy. And I'll tell you why in a moment. Well, right here, looking at the NASDAQ oscillator, we got oversold just last week. We said it's not staying here for long. It's going the other way. Bottomed out at minus 90, ricocheted back to neutral, and now we're back down at minus 50. Now remember, this is an end of day indicator, so you can't just look up at Powell, at 2:30 and say, oh, I wonder where the NAMO is. You're not going to be able to get it. So that's where your judgment comes into play. Just know, if you get a giant VIX spike and it runs up to fill that gap, that'll be a technical check mark having that gap filled. We know resistance on the VIX is 29 to 30. We also know that the oscillator is getting stretched again to the downside. And if we were to go over to NIMO, I'm not going to show it, but it's the same place. It's like minus 47. So we know at minus 60, the oscillator is on borrowed time, right? Here, we get the oversold signal. We can see or have overshoots that go down to minus 90. But once you go past 60, you're on borrowed time. So if there's some kind of a flash move, giant red bar, oh my God, VIX spikes to 29, everything's going to hell in a handbasket. Look at your charts, pick your spots, and buy it, because we're going to go oversold. The oscillator's going to go down here, and it won't stay down there for long, is my point. And you can say, Chris, how can you be so sure? Well, look at the past 5 years, if you will. Just last week, minus 90, rip. Here, minus 60, rip. Here, minus 80, rip. Right on down the line. It's just, and remember, our percent over 50 is way down there at like 20%. Some of the lowest readings you ever see in the market, only 20% of NASDAQ stocks are above their 50. And it just doesn't go much lower than that. So, at least for a bounce, right? A relief rally bounce. Now, tomorrow could be the first day of a bear market. We don't know that, but bear markets aren't unidirectional. They're going to be, characterized by rips, selling the rips and buying the dips, right? Instead of the other way around. You want to fade. If we roll over, you got to reorient your mindset to fading strength instead of the bull market mode of buying weakness, right? Buying dips versus selling rips. But that'll all have to play out. All I'm trying to say, in probably a wordy way, is if you get some kind of disaster move over the next day, day and a half, 2 days, you know that the oscillator is going to be oversold. You know that VIX is going to spike and fill that gap. And you know that the percent below 50 are at the lows, and there's only one way to go, and that's up. So doesn't mean I'm going to be right, but the odds are certainly in the favor of, if you'd ever want to get long, you want to get long when the oscillator is stretched to the downside and basically has to more or less bounce. So let's look at yesterday's action. A lot of good trades out there yesterday, man. And you know, it's funny when you see the trades, you make the trades, and you make money. They all seem easy versus other days where you just shake your head and you just couldn't get in sync with the market. So yesterday for me was easy because I was in tune with the market, and I hope you were too. So SPY 2 hour, we closed the day on Monday here, right about 467, give or take. And then we had the big gap down, but then that first candle, we had a reach up to try and close that gap up towards 466. And that's where the initial little rally died, and then it rolled over, came down here, bottomed out. There were 3 candles here on the 2 hour chart, so that's like 6 hours, right? Of moves down to 460 that held, and then we got a good a bounce into the close. Now what I've done here, just for illustration purposes, is drop in the fibs high to low of the move. And so we've bounced to that 38% fib level. We've got the 50% right above at around 465 and a half. And then we've got a 618 retracement here at 466 spot 71. So those are the levels where if you get bounces today, depending on when you get them and what's going on, these would be locations where you'd expect or anticipate a reversal or a sticking point on the chart. So if you know where those levels are, you can, hone in on your radar. Here it is on the 30-minute chart. Here was the reach up candle, and then the move down into this gap. Notice that we didn't fill the gap. We came 3/4 of the way down. Now, this support line that I have my cursor on, I added that. So that wasn't there yesterday. I added it after the fact. I didn't really pick up on thinking that this prior top of the gap, you can see a reaction here, and here was the prior gap. I really didn't think that would be a level where price stopped, but it did. So when you have a situation like that, you're coming down, say there's no line here. Say I hadn't added that like it was yesterday. And you see, we had a candle touch down here, 460 and a half. And then we had, let's see, 1, 2, 3, 4. We had 6 candles touch the low. Whenever you see that, it doesn't matter if it's in outer space. There's something there. And if you see that when there's nothing on the chart, you can scroll back in time, and I can almost assure you that you'll find something that where there's muscle memory around that level, and you didn't have to go back very far to find it. Here was the level, and that corresponded to the top of the gap. So that was support. And so if you had gotten short at any point higher and you saw, 5 or 6 30-minute candles where the bears could not crack it, then you knew or had a pretty good inkling that was a low and a chance for you to get out of your short and then flip long. And if you did that, you got a really, really nice bounce. Same kind of idea on Qs. That first drop down and reach back. Did not get very far. Got up here above 389, reaching towards 390, and kind of faded and then went down. And then there was a reversal point. I want to show you on the 30-minute chart because it's a lot easier. Here was the gap down and the reach up. And, if you did not engage it at 390, that's not a big deal. That might have been a hard trade to make. That might have been you weren't really focused on it. But then when you came back down here to 388 and that failed, that was another logical place to be short, and you got a big flush move down here. You had a big candle come down to 382, but that got quickly bought up, right? And then you had the same thing that you saw in SPY, and that is a multi-hour base right here at 384. I called that out in the trading room yesterday, that 384 was support, because you had all these candle touches below, and that was a logical place to rotate out of your shorts and to get long against 384 with a stop below, and that resulted in a nice lift. So that was a nice two-way trade. Short into support, easy base. What I mean by easy, it spent 3 hours there. Sometimes you get, a true V bottom where it goes into support, they buy it up immediately, you don't believe it, you stay short, and then they give you a giant follow-up green candle, and then you see all your gains on the short side evaporated really, really quickly. When it has more of a U bottom like this, you've got time. If you recognize that the bears lost power, they can't break a certain level, then that's your cue to get out and wait for the next move. IWM, 2-hour chart here. Not a ton of travel, but certainly enough to make money. We had a little kickback rally into 217. That was clear resistance from this large volume over price bar. We had an initial drop down below, but then there was a kickback rally into resistance, and that would have been a beautiful place to lay on a short. And if you did that, you got 217 down to 213, where we said all along, if you go back and look at yesterday's and the day before, I said I thought price would come down to test these lows. And it doesn't always pan out the way I think it will, but in this case it did, and that was a logical place to cover your short because you're at the prior lows. Now, what I want to point out, and you'll see this on a number of other charts we're going to look at this morning, is the divergent low. What is that? You've got price at the same level, but look at the positive divergence on momentum. Here price is at the same level it was here, but momentum is a lot higher. You've got a little bit of positive divergence on RSI, not a ton, but I mean it's there. So be aware of that. And that's a recipe for the bottom is in kind of a move, right? So your confirmation of that, by the way, this is, you've got bullish divergence at the low, but your confirmation, if you will, is to see the bull cross here in momentum, to see that actually curl up and put in the bull cross. But for my money, of course, if you wait to see that, price is going to be up here, right? It'll bounce, and then you'll get the lagging indicator to trigger. What I like to do if I've got a double bottom setup with divergence, just get long against the low. Get long against 213. That way, I mean, you're at the low. If your stop is violated, you're wrong. It's going lower. Because you would have broken the prior low. If that happens, you're just going lower. But otherwise, if the divergence plays out, then you've got an awesome trade location right at the double bottom low. Here we are on a 30-minute chart. I mean, basically same deal. Not a lot to see here. We've got a big volume over price bar right here at that 216, 217 level, which has to be overcome on the way back up. That's going to be your first resistance point. And of course, you can always drop the fibs on if you like to get the intermediate levels. Just as I'm looking at it here, looking at the classic double bottom, look, you've got, just picture the letter W. You've got a leg, a leg, a leg, and then possibly a leg up here. So that would be your W bottom, and you hear that talked about in TA books or people talking about double bottoms. You often see that W pattern. All right, Facebook. I mean, this to me was an easy trade. Why? Here's where we closed the day on Monday at more or less 334, 334.49. We gap down. We come right to the level that was the prior low, right here, 327 is where that's at. So we come down, we flash the low, and then they buy it up and close the opening gap. When they did that, and then once that gap was closed, they instantly reversed it. So your entry point was when price broke back above, but then failed and moved back below, then you had an entry there at 334. And then it went right back down to the lows, back to 327. And then you had your multiple touches down there. And then you got a bounce. So I was able to get a good chunk out of Facebook. So today, we're from a technical standpoint, we're at exactly the same spot as we were heading into yesterday, because they went down and pretty much closed it right at the Monday low here at just call it 334, 333.75 right here. Apple wasn't in this, but was watching it the whole way. This is where we closed. We closed at 176 on Monday. Yesterday morning, before the bell, in our prep talk, we talked about you don't want to see price lose 176, because that's your breakout, right? Breakout back test. We said if you lost 176, your last chance to save it was 174, and that's exactly what they did. They bought the open. Here's your wick, and then they sold it down. Your entry, your short entry, was on the break of the prior low or the prior day's close right here at 176. You got a big follow-up bar that took you down into the high 173s, and then you had a couple bars where they probed that 172 level, but the bears ran out of gas. You could have covered anywhere along the way, but a definite place to cover would have been on the recapture of 174, and that should have been resistance. If this was going to go lower, that should have been resistance at 174, because here you see that was the bottom of the bear flag. So I think Apple had a really good opportunity there to capture a couple of dollars, if not 3 or 4, depending on when you got out, and also depending on when you got in, a chance to get back on the long side. Tesla, we had talked about, let's see, where did this open? Yeah, it opened at 9:45. So it opened on this gap down here. Here was the day before. We talked about 970 at this prior low being an important level. Now it came down. It came down into the gap and stopped here at 930. I added this green level is new. I added that. I probably should have had a bar there prior to yesterday at the bottom of this little value range. I didn't have that, but you did see that price, found support, had 3 or 4 bars here right at 930, and they couldn't break it. Now, today, that 970 is your pivot point, and you know that is resistance. Why? Broken support becomes resistance. Here it was support. So that's a pretty significant line there. If you got some kind of a move into 970 and you saw that it couldn't get through, then chances are it gets rejected and comes back down to fill this gap. Now, what I want to tell you about this morning is you may have the whole market or specific stocks just kind of oscillate, go into suspended animation mode. So typically, the morning of a Fed meeting, you're not going to have, you don't usually get, fertile markets for intraday moves. It's just going to be, really, really muted action. And then things will break after the Fed announcement. So as I tell you, these levels, that doesn't necessarily mean there's going to be some kind of compelling trade there, because I think a lot of people are going to be waiting. Microsoft is where I really got paid yesterday. We had a prior gap down here that I've taken off, and we had a big gap up here. Now, we had closed way up here on Monday, right? And we said 338 was a big level because of all this support that should have been there. And we said all these levels down here were important, all the way back down to the bottom of the box down here at 330 was going to be important support, because it was support back here. And so when there was this reach up yesterday, I think it reached up into like 335 and then fell apart. I didn't get it. I didn't get it right at 334, but I got it soon afterwards. And then as it went down, I got more and more emboldened, or I had confirmation. The loss of 332 was a check mark for the bears. And then when it got down to 330, that's when I covered. Why? Because I thought all of these support layers would have held, but I still was watching it. And then when the prior low on the next candle was broken, then I got short for the next run. and then was able to get the second leg down here, and I covered down in this 325 area. I did not get, I didn't flip long, but that was a logical place where you could have. So I was able to get this good leg down, which was nice. So here we went down. Now we've got this little bear flag action. Notice that all this support now is resistance. So you've got a beautiful line there to shoot against. 329.5, 330. You get a break into there that holds, then I'm not going to guarantee you, but your target would then be the bottom of the gap up here at 334, and then you break that level, the top of the breakdown candle, then you're going for the gap fill. I want to make note, there's another gap down below that's off the chart down at 315 to 309. And so if there's a move today or tomorrow, whenever, if you lost this low, then it's going to come and test this low at 318.50, and that'll be a nice trade to take, because from 324 to 318, that's $6. So been a long time since you've seen a 4% drop in Microsoft. Amazon, if you go back and look at the prior videos, we thought that price was going to come back and test this prior low at 33.40. That's what it ended up happening. You do have some positive divergence here on PPO momentum. So you've got that double bottom setup. I've got your pivot point right here at 33.80. I think if you break above that, you're going to come up here to the bottom of this old gap. And then you've got 34.20, 34.40, and 34.60 as overhead targets on any kind of a bounce. And be aware, now if price breaks back below 33.40, then you're taking the next leg lower. Google, we had this prior gap. We broke down, didn't really get much of a reach up. Came down, undercut this 28.40 level, found some support, and then bounced. So today, 28.90 is your pivot, and you've got a gap from 28.90 up to 29.15, it looks like. So I will move this gap up to this level here, and then that will be your first objective on the high side to shoot for on any kind of bounce. But I will say the same thing that I said on the other ones. I think it's got to come back and test this level. This level looks too important to just, okay, that was good enough. Now we're going to race to new highs. If you look at this one, it would set up as that W pattern again. Here's leg one, bounce, back test the low, and then back up. And then that would be your W formation. Doesn't have to, but this spent a lot of time back at 28.10, and I think it's going to head back there, even if it's just for a touch. Netflix, put in your divergent low. What's a divergent low? We just talked about it. Here we had a low. Here we've got a lower low, but at higher momentum. That's your true divergent low, where the second low is lower than the first, but momentum is higher and RSI is higher. And, if you get a break above this, 597.50. I think you can get long there and then look for 511 and then on the way back up. And then you can set your stop just below this 597.50. You can set it back down here at 595 or something like that. And if it comes back down again, it's probably going to go even lower. Wrapping up here with semiconductors. We had the big gap fill on on Monday. And then yesterday we lost this 299, came right back down to test this prior low at 294. Doesn't look like much, but that was $5 going from 299 to 294. Here again, multiple candles at the prior low where the bears lost power. Good place to reverse and get long, or simply to get long against the prior low, and you got a nice $5 bounce. So let's do a quick wrap up. We're entering a liquidity regime change. Usually that means turbulence. Doesn't necessarily mean resolve down. We've got a gap above on the VIX that I think has to get filled. We are stretched to the downside on a lot of the breadth measurements and oscillators that have been so good to us through the months and years. Got the FOMC. First move is often fake. Don't get all excited and on that first 2 or 3 bars. If you're not sure, just wait. But if you get the feeling, if you get a moment where it seems like the sky is falling, and you get that massive whoosh down, I think you want to be a buyer down there after that VIX gap fills. But if you do get long, make sure you buy some time, because if it doesn't bounce like right away, then you'll be all panicky and want to get out. Make sure you buy some time and give those oscillators a chance to rebound. So I'm going to wrap it up there. If you're new here, thanks for the time. Hit the subscribe button and the alarm bell. We'll keep you locked and loaded with a lot of objective levels. Okay. Keep your head on a swivel today. Hope you have a good day of trading. This has been Chris Buss with Trader's Profit Compass. Talk to you next time.